Welcome to the Veterinary Financial Podcast, where we discuss financial freedom and professional success. I'm Meredith Jones, a veterinarian and financial planner for vets.
And I'm David Azis. I'm also a financial planner for vets.
David, I heard that you have a scary home buying story to tell us.
I do. And so for today's episode, we're going to do something a little bit different. But basically what happened was I was at a friend's party. It's a friend of a friend that I met. I know him as an acquaintance, and they know my past experience in mortgage, and also they just happened to buy their first home. Okay, so they're telling everybody, me and everybody else, the crazy story that happened to him. And it was kind of a crazy story, but it's also not as rare as you'd think. I've run into similar stories like this one tons of times when I was doing mortgage full time. I just thought, oh my gosh, I don't think people talk about this enough. Let me tell this story to all of you guys, the good, bad, and the ugly, and how you can possibly avoid it yourself, because it happens a ton and it's a huge mortgage mistake. And for everybody, and I know a lot of our listeners out there probably either want to buy their first home, are looking to buy their second home, selling and buying a property, looking to get into rental real estate. My guess is at some point or another, if you're listening to this podcast and therefore you are probably really interested in personal finance and growing wealth, that at some point the majority of our audience will be involved in real estate in one capacity or another in their lives. And so if this story can tell you what to not do, then I think that'd be valuable for you guys. And at the very least, maybe it's a little entertaining too. But I heard this story from him and I was just like, it grinded my gears so much that I opened up my phone and put on our podcast list ideas that we have a running list of ideas for episodes. I was like, we got to talk about this. So, it's Friday near the end of the day when we're recording this, and we figured, let's do a story time episode with hopefully some takeaways that will save you guys $50,000. And that is not an exaggeration with this story. With that being said, Meredith, I'm just going to hop in. I'll tell the story, and then you can ask me questions on it, and I'll give my 2 cents of how you can avoid that.
All right, cool. Go ahead.
So here's what happened. First-time home buyers. This is in San Diego where I'm at, so higher cost home, right? They are working with their realtor. Probably took them 3 to 6 months of actively looking, which is normal. And they got a townhome under contract in a very nice area. I think it's a great buy for them for what they were looking for, but they weren't 100% sure who they were going to use for the loan. Like, they were working with their realtor and a few different loan officers, the person doing the financing, pulling the trigger, pulling the strings behind, the mortgage process. They were working with a few different lenders and loan officers at the same time throughout the offer process. Which you can do that. It's just a lot of different cooks in the kitchen, okay? There's a lot of work to be done on the lending side that goes on in the background that a lot of people just don't know about. Closing a loan these days is a ton of work. So if you're working with multiple different lenders, that might be a lot of different cooks in the kitchen. Because think about it, by the time you get your offer accepted, a lender has to reach out to the escrow company that's facilitating that transaction. And that's always picked by the seller's realtor for the most part. And so already you've got multiple different lenders asking this escrow company handling your transaction for docs. And now the escrow company doesn't know who's handling the financing. So they don't know who to ask for what, by what dates. And your realtor is now caught in the midst of all of it, trying to talk between like 5 different people where only 2 or 3 different people are going to be really at the closing table. So it just caused some confusion, but it is pretty common. You can do it and not cause this horror story. It's just, that's the first thing that, in my opinion, where it went wrong, is too many cooks in the kitchen and nobody knows what's going on. Meanwhile, you've got contract dates to meet. So they get their offer accepted. They go into escrow. So what happens next normally? Well, that's when you've really got to lock down your loan and really figure out who's doing what. But for the next couple of weeks, they were going back and forth between 2 different lenders, one of which was a loan officer that my friend and his wife, they really liked. This person was the type of person to wake up on a Saturday morning to help them change their pre-approval, to get that next offer out, to get the offer accepted. right? It was the lender who was throughout the entire process up until that point, answered all their questions within like 15 minutes, texted them back, emailed them back, called them back. They had no complaints about this lender. The other lender that they were going back and forth with had an interest rate that was better by, I don't know, maybe 0.25% better. And for reference, 0.25% difference in a rate on a 30-year fix on like a $900,000 property might be like $60 a month in the payment.
So not life-changing then.
No, and this is in, I would say, above average purchase price. If you just take the average, for all our listeners who don't happen to live in San Diego, I guess I'm a little jealous of you because it's a little bit cheaper. So just maybe the other moral of the story is don't move to San Diego. That's a different episode though. But for everybody who's buying in like the $400,000 to $500,000 range, which is, pretty common in other states outside of California, we're talking maybe a difference of like $30 a month in the payment. You don't even know your homeowner's insurance yet at this point, which if that is $2,500 versus $1,500, that makes more $1,000 a year in homeowner's insurance is like $80 a month. That would make a bigger difference in your payment than the difference between these two lenders. Okay. So they chose to go with the cheaper lender to save the $60 a month or whatever, even though they really loved the other lender. And the other lender was honest with them. They said, and when it came time to lock your rate, and keep in mind, rates change every single day. So maybe we have a more technical episode about rate locks in the future. But for now, just know that when it came time to lock their loan with the quote, what would have been the better lender that they liked more, the lender was honest. I can cut my commission on this, and I still can't match their rate. It's a really cheap rate. And they were like, well, we're going to go with the cheaper rate then, because that's better, right? My friend said, we did what everybody tells you to do. Shop around. And they found the lowest rate. So they were like, well, you already got the offer accepted. Because people think that closing a loan is like clicking a couple buttons and like, that's it. No, closing a loan in 2025 is one of the most crazy financial puzzles for someone to solve. It's a weird profession where, yes, the LO is a salesperson, but it's like they need to know the 1,000 pages of regulations of Fannie Mae, Freddie Mac, FHA, VA, jumbo, all that kind of stuff. So that way they can argue with an underwriter when the underwriter makes a mathematical error, right? It's weird. Most salespeople don't do that, So long story short, they went with the cheaper lender, and guess what? There was a surprise a couple days before the close date. Now, this cheaper lender was with a big, well-known bank. I won't say the name because I don't want to get sued, but also I don't actually even remember. If I said the name, you would know who I'm talking about. It's a big organization. And this part actually blew my mind. A couple days before closing, they reached out to this guy and he said, my friend of a friend, hey, we have a problem. In order for us to actually get you that rate, you need to open up a high yield savings account with us and deposit $50,000 into it.
Ooh, what? Like, okay, $50,000 in the high yield savings account in order to be able to buy this house.
Yes.
Wow.
Not to be used in the transaction, just, hey, in order for us to close on the terms that we promised, you need to open up an account with us and put in $50,000.
Yeah, so it can't be used on the down payment. It's got to be sitting there.
Yep. And this is like literally 2 or 3 days before they were scheduled to close. And it was funny, and I've seen this happen before, not this exact scenario, but they said it so nonchalantly to my friend.
Oh, wow. Like it was nothing.
Like it's not a big ask to just, hey, we need you to transfer $50,000, like right now.
Not $50, but $50,000.
Yeah. Most people don't have just an extra unexpected $50,000 laying around. And neither did this person. So this person was like, I don't have $50,000 extra on top of what I need to bring to the closing table. I've got like 20. I don't got 50. And so what did they have to do? They had to go ask their parents to bridge the gap to fund this high yield savings account. And you might think, oh, no big deal, just take the money out after close, right? But apparently, and again, take this with a grain of salt, this is anecdotal, but I'll tell you how in my own experience, I've seen some similar things to this happen. They said, you have to keep this money in the high yield savings account for a year. So you couldn't just put 50 grand and then take it out the day after close, in which case, sure, borrowing 20 grand from your parents for a day and then giving it back, no big deal, right? Weird, but it would have been less of a deal. But they had to lock up $50,000 supposedly for a year in order for this lender to close. To be honest, this just smells like illegal to me. I cannot believe that this was even allowed. But, illegal stuff happens all the time in the financial services industry. It's just not everybody gets caught. And maybe I don't know the whole story. I'll give this lender the credit. Maybe they misunderstood something, but still. Now they have another account with this entity. There's like 50 grand in it. And they closed, and yes, they got the best mortgage rate ever, which they might only hold for a couple years anyway, because their plan was to refi if and when rates come down anyway. So keep in mind, your 30-year fixed isn't also a 30-year decision. You might only be saving that $50 a month for like 2 years.
Okay, so I'm just thinking about this. All right, so they had to not only they had to borrow money from their parents and put their own $20,000 into this account. So 30 from parents, 20 of theirs. And it has to stay in there for a year. And all they ended up saving was like $60 times 12.
Yeah. Or heck, let's say they don't refi for 3 years. $60 times 3 years. Maybe they saved $2,500 by going with that lender over the course of 3 years. Meanwhile, they had to, the 3 days before closing, really scramble to come up with $50,000. That was probably the most stressful thing ever for them.
Yeah, and I mean, lucky them that their parents were able to put that money in. A lot of us wouldn't have had anybody who would be able to do that.
It's a great point. What would have happened if they couldn't just go to their parents for an extra $20,000? And yes, they're going to give that back. So, I'm not saying they're spoiled or anything. It's just that is kind of lucky that they had that resource that they could use. Not everybody has that. And so what would have happened? Would they have lost the house? Or what, even worse, would they have lost their earnest money deposit? Because this is like a few days before closing. So realistically, all the contingencies are passed. What that means is there's certain dates throughout the, let's say you're doing a 30-day close, you can back out for different reasons up until a certain point. Like if you get the home inspection back and there's an foundation's cracked and nobody knew about it and and the seller doesn't want to pay for it, well, then the buyer can legally walk away and get all their money back, basically. That earnest money deposit, for anybody who hasn't done a transaction yet, it's like usually up to 3% of the purchase price. It does go towards your down payment, but you put it up front right at the beginning of the purchase process for the escrow company to hold. And if you close, it will go towards everything you need to bring to the closing table. But if you back out of the contract for a reason that's not legally binding, the seller could just keep that deposit. So on an 800 grand property, 1% is $8,000. 8, 16, 24. So their earnest money deposit was probably around 24 grand because 3% standard for a deposit in San Diego. So yikes, what if they didn't have the ability to just find an extra $50,000 one way or another and were 2 days before closing? That is a case where technically, if they had to back out because they couldn't close now, then the seller would be entitled to just keep $24,000 from them.
Ooh, wow. What a crazy story. So, okay. So what can a veterinarian do to ensure this doesn't happen to them?
If you find yourself picking between two lenders and you're absolutely in love with one of them, like my friends were with the lender that they decided not to go with, and another lender who is slightly cheaper, 1/8%, heck, even 0.375% better, if it's that close, and thing you could do is just go with the person you like and trust, because these are big numbers we're talking about. Yes, it's cool to save $60 a month. It is cooler to not be at risk of losing 24 grand. And so look at the big picture and go with the person that you trust to handle this giant transaction and not screw it up, and make sure that they set the right expectations. Because it's also, even if you do close, like, I can tell you from personal experience from buying my own home and also from doing 100 plus transactions for other people, even if everything ends up okay, when there is something unexpected that happens, it's really stressful. And so someone who will set the proper expectations up front and make sure that closing runs smooth and keeps your life easy is totally, totally, totally worth an extra $50 a month times 3 years. Even if they never refi, it is probably still worth it to not have to deposit 50 grand into this account for 1 year, because heck, what if they're not already maxing out their 401k and they could have used 23,000 of that 50 grand to max out their 401k? The numbers are insane. So if you count opportunity cost of like what that 50 grand could have done if not locked up for a year, I'll get off my soapbox. It's just, it really grinds my gears because this stuff happens all the time. Maybe not necessarily requiring to put 50K in an account, but here's something that I've seen actually happen in transactions, like from watching other LOs do, because I never did this.
Loan officer.
Oh, sorry. In mortgage, there's a billion different acronyms to make us sound smarter than we actually are. Anyway, so I've seen this happen. It'll be very common that you go with the cheap lender, they screw up the math, 3 days before close, they're not asking you to deposit money anywhere. They're saying, hey, there's a debt to income ratio problem. We miscalculated your income, or we didn't include that one debt that we should have, or we didn't see, the alimony that you pay, but the underwriter found it on your bank statement when you provided the docs for what you're going to bring to the closing table. Now everything's screwed up. We can't close unless you go pay off your auto loan.
Oh, man.
So, hey, no big deal, borrower. That $30,000 auto loan you have on that truck, hey, no big deal. Just go pay that off and we can close. What? It's like, hey, no big deal. We just have to put $50,000 more down. No big deal, right? You can do that. 3 days before closing, I've seen both of those things happen where the lender will just be like, hey, no big deal. We can fix this. Sorry for the short notice. Can you put $50,000 more down or go pay off that 30 grand loan? Most people don't just have an extra $50,000 to do that. They've already done all the math. They've calculated what they need to bring to close the home. And like, even if they can do it, a 30 grand unexpected thing, a 50 grand unexpected thing that could have been avoided before getting under contract, it's the most stressful thing ever. So back to your question of how do vets avoid this? One, if you find yourself picking between two lenders and you're picking between the cheapest option and the not cheapest, but the best person who might be competitive compared to other lenders, but might just not be the absolute dirt cheapest, well, do what you want. But I think you know where my bias is. Go with the better lender. Don't go with the cheapest, because the cheapest might end up costing you way more money than the quote not cheapest lender. But everybody says shop. You should shop. You should interview different loan officers. But that doesn't mean you should go with the cheapest. Thank you for coming to my TED Talk.
Yes, good cautionary tale. One thing that I think a lot of people get confused about with mortgages and thinking about interest rates is, okay, you've got your mortgage loan officer. So if I have this right, David, some of them, they work for a particular lender, right? And some of them can shop around and compare rates between lenders, right? Like, how does that work? Like, does the particular mortgage company matter?
Well, there's a few questions in there. I'll answer does the particular mortgage company matter? In my opinion, the answer is no. You always hear like, oh, it's better to go with a mortgage broker, which I worked for. Brokers are great. You could go with a direct lender. So the entity that you're speaking with is actually the one funding the loan, for example. You could go with something called a retail lender. You could go with There's lots of different business entities. You could go with a credit union. There's a lot of different entities that do mortgage. I don't think one entity is better than the other. So a broker could be great. A broker could be the worst thing ever. A direct lender could be great. It could also be the worst thing ever. A big company could be the best thing ever, or it could be the worst thing ever, because realistically, you are working with one main person who's quarterbacking the whole mortgage process. And at a large company, because I actually spoke with a realtor a couple weekends ago. He was a newbie realtor. He was asking me some questions on the mortgage side. And he was like, my realtor company, the brokerage that he set up with, has their preferred lender. And I won't say any names, but the preferred lender is a top 5 largest mortgage lender. Like, everybody in the business knows them. I have nothing bad or good to say about that lender. They're so big that they probably have thousands of loan officers. And so there's probably some really good loan officers that work for that company. There's probably some okay loan officers who work for that company. And there's probably some really bad ones who work for that company. And every mortgage company is like that, because not everybody is a winner. It's just the reality. Does the particular mortgage company matter? I don't think so. I've seen great loan officers at Company X and also the worst ever at Company X too. And so, does the mortgage company matter? Again, no. Interview the person. Don't go by their company. Doesn't matter.
I think that's similar to a realtor, right? Like, you choose your realtor based on the person, not what agency they work for. You're choosing based on the person.
100%. I would never choose a realtor because of the particular company that they work for. There's a lot of great real estate agencies. There's a lot of bad ones. There's a lot of great agencies that have so many people that, just by law of average numbers, like, there's good ones and there's bad ones. It's who are you working with? It's like saying, I don't know if I trust ordering from Amazon because I don't know how good of a delivery driver, Jeff Bezos is. Like,
oops.
What? Like, he's not the one delivering the thing to you. You know that, right? The CEO of a mortgage company isn't doing your loan. So I guess the thing is, and this is for a lot of different types of services too, it's not just mortgage. Cheapest isn't always best. And for a veterinarian whose time is so valuable to them, if you go with the cheapest option for anything, but especially your home purchase or anything real estate related, it might cost you more in the long run, and it might make you want to bang your head against the wall of the house that you may not own anymore because the transaction did not go through and you lost your earnest money deposit. So you go bang your head against the wall of the house that is no longer yours.
Well, thank you for helping us avoid these headaches, David.
Hopefully this was at least somewhat entertaining for you, or at least educational, and now you know what to not do in the mortgage process, or at least one thing not to do. But if you want to pick our brain more, or talk to us, or whatever, pretty smooth transition. What if you could get fiduciary, veterinarian specific financial planning that's student loan aware that could change your life? Go to slpwealth.com/vet. That's slpwealth.com/vet for a free 15-minute intro call to see if we'd be a good fit for you. I'd love to talk with you. Would love to nerd out about mortgage or whatever you want to talk about.
All right. I think that wraps it up. Until next time, take care and continue your path to financial success. This podcast is for informational and educational purposes only and should not be considered individualized financial advice.
If a specific investment is mentioned, it should not be considered a recommendation or endorsement to buy or sell the investment.
All investments involve risk.
Past performance does not guarantee future results.
You are encouraged to seek the advice of a financial professional before implementing any investment strategies discussed.
Yay, compliance.